would like, if I may, to take you on a strange journey.
Hello, everyone, and welcome to another edition of Real Estate Realities with the Rebel Broker. My name's Robert Whitelaw, and I am the Rebel Broker. Licensed real estate broker in the state of California, member of the National Association of Realtors. But please don't hold that against me. Welcome to it, folks. If you'd like to get in touch with me, the best way to do that is to head on over to the website. Just head to therebelbroker.com. From there, you can reach out to me directly. Or you could visit the store, do some shopping for some great books at Amazon, and support the show at the same time. You could take the survey, a big red button at the top of the page that says take the survey to support the show. Not only are you supporting the show, but you are also entered in to win next month's $50 Amazon gift card. We've given out 4 so far. It's 4 different lucky winners. So head on over there, click that, offer the same email address both times you're asked, answer a handful of questions, and you are in the drawing for that $50 gift card. If you'd like to join the Rebel Underground, just text the word Rebel Broker to the number 44222. That's text the word Rebel Broker to the number 44222, and that will get you on the special mailing list for the Rebel Underground. I'd also like to let everyone know I have made contact with all of the winners of the copies of Francis Greenberger's autographed book, Risk Game. So all those folks have been verified. I've got mailing addresses for everybody. It's all set to go. Congratulations to those of you who won the drawing for that. If you did not get a chance to listen to my interview of Francis Greenberger, real estate billionaire extraordinaire, last week, I think it was Wednesday is when that interview was posted. Let me suggest you go and check it out. I think it went really well. And he's a fascinating guy, and his book is kind of amazing. So if you didn't win a copy, head on over to therebelbroker.com, and I believe it's right there in my recommended book list. If not, just go to the show notes for the interview show, and you'll see a link directly to the book for you to acquire it over at Amazon. Okay. Anything else any housekeeping stuff I wanted to share with everyone? As I mentioned last time, I am hot to get ideas from you, my loyal listeners, on A, a new opening quote to start the show with, and B, ideas for a new logo for the show. I've basically been using the same logo, which is my open-mouthed screaming face, ever since I started the show in 2007. I think it's time for an upgrade. The show's matured a little bit. I think it's maybe time for a little bit more of a mature logo. So I would love to get suggestions from you. So feel free to send those to me. You can send those to me at the website. Just head over to therebelbroker.com, click on Contact Me, and let her rip. All right, so we've got a couple of topics I want to hit today. I'm just not sure one of these is going to do a whole show, but so we may end up doing both. The 10 housing markets with the best bargains, and there's a variety of reasons why we want to talk about that. And then we've also got a housing market prediction that comes to us from Brad Hunter, and there's really not a whole lot there. So I'm thinking maybe this will be enough to give us some interesting brain food for the next day or so. The first article comes to us from Realtor.org, and as I mentioned, it's the 10 housing markets with the best bargains. What they did is they researched 300 of the largest metro areas and figured out the share of homes for sale that saw price reductions over the past year. So this is interesting for a variety of reasons that relate to a bunch of different potential positions you might be in, whether you're a buyer, a seller, or an investor. Now, of course, reduced prices represents a potential opportunity. Now, remember, I'm talking about a potential opportunity here because you're going to want to look at these different marketplaces and see where you think they are in terms of the cycle. And oftentimes you can look at past numbers to try to get a little bit more informed about what's likely to come down the road. But you want to see if you can figure out if this is a temporary scenario where you're likely to benefit from appreciation over the next year or in the future after acquiring at this low point. The other thing is, if you're someone who already owns investment property in these communities, if you're already renting, this may represent a situation where you're going to see a little bit more challenge to you as a landlord, because as it becomes more affordable for folks to buy homes in a marketplace where you're renting a single family residential home, the probability of losing a renter to them purchasing something increases. And it also tends to lower the pool of renters as more people are able to buy. So that may also affect your ability to get the rent you need for your property. So you need to start evaluating where you are in terms of cash flow. At the very least, numbers like this should kick off an analysis of your holdings if you're in any of these metro areas. If you are a seller, this may be an indicator to you that you really want to take a closer look at your marketplace to determine if now really is the time to sell. You may not want to do that. You may want to hold off. You may look at the numbers and decide, you know what, I'm confident that this is going to change in my favor over the next couple of years, and I have the resources to hold off, so I'm going to do that. So it's always good, I think, to keep an eye on these types of things. And I thought we'd go down this list because there's actually a couple on here that are interesting. Very interesting, because they have shown there are communities on here that have been on some of our other lists where you wouldn't think that these are bargain areas. So we'll go through this list and see if we can't figure out what's going on. All right, so let's try to set the stage here a little bit. I'm reading directly from the article here. Home prices are rising in most areas, but a few large metro areas are seeing some big price reductions that may be opening the door to some home buyers this winter. Quote, despite the fact that home prices are now setting new records in most of the country, price reductions on listed homes are quite common, according to Jonathan Smoke, Realtor.com's chief economist. Quote, a price reduction can happen for lots of reasons, including in just adjusting an unrealistic initial price, a new sense of urgency, or motivation by a seller, or declining market trends. And there really are a couple of mind-blowing communities on this list, so let's go down and check it out. Now, remember, these are the 10 highest price cuts. We're starting with the 10 highest. We're starting at number 10, working to the community with the highest discount from home price. Number 10 on this list, which kind of surprises me, San Diego, California, with a 27.6% price reduction. Excuse me, I'm sorry, not a 27.6% price reduction. The share of homes with price cuts. So these are the number of homes that ended up cutting their prices in the marketplace. So I think that gives you a little bit better insights into what numbers we're talking about here. Now, if you are in any of these areas, the next thing you're going to want to figure out is by how much did different homes end up going below their asking price. Simply because that's going to give you an idea of whether this is a minor adjustment in that particular community or it's a big adjustment. But in any event, San Diego, California saw 27.6% of the inventory get a price cut. Number 9, Palm Bay, Florida, 27.9% of homes on that market saw a price reduction. Palm Bay, Florida, if I'm not mistaken, has been on a couple of our lists in terms of strong investment areas. So that shows that we're seeing, with over a quarter of the homes potentially having price reductions, it indicates that you may be able to also be able to negotiate a little bit more aggressively in terms of it being reasonable for you to ask for below asking price. Now, also remember, this is a number that can depend a lot on the psychology of the market. If you have got some very bloated markets, and we're about to head into what would probably be bloated territory, it may simply be that sellers' expectations were out of whack with reality. We did see a flattening, a slowdown in the amount of growth in prices in some of these markets. And this may simply be a reflection of the fact that sellers were expecting this continuing increase when things actually flattened out, because we're coming up on one here that I think is going to blow your mind a little bit. Number 8 on the list, Baltimore, Maryland, another one that has been on a variety of lists of very desirable locations. 29.2% of homes had a price cut. Next, Vallejo, California, 29.3% had a price cut in the marketplace. And here's the one that I think is going to blow a lot of people away. This is a community that we've talked about a lot. We have had actually listeners reach out who are trying to buy in this marketplace, who have talked about how nuts the housing market is. I've had several folks from this market talk about how hard it has been to acquire a home. Denver, Colorado, with 29.5% of homes having a price reduction. That indicates to me that what we may be seeing in Denver, because in every other way, and every other metric we've looked at relating to Denver, it's still a strong market. So I don't think it necessarily means that what we're seeing is a decline in the market, but I think what we're probably seeing is just a flattening of how much prices are growing, and sellers just weren't expecting that. They were expecting to be able to ask for more and more and more, and they've sort of hit the ceiling on that. Number 5 on our list, Springfield, Illinois, 30.6% of properties saw a price reduction. Next one, another majorly interesting number, because this is a market we've talked about quite a bit. This is a market we talked about several years ago in terms of it being a super hot market that you should invest in immediately because it's going to go through the roof. I think this is one of those where we talked about it in late 2013 and suggested strongly that you invest in this particular community. Or was it 2014? I can't remember which. But then the following year, it blew up and prices went crazy. Austin, Texas, 31.5% of properties saw a price reduction. And again, I think this is in the same boat as Denver, but it's absolutely something where you want to calibrate yourself to this number to realize that with this showing such a strong number of homes that aren't going for asking price, that are going for below asking price, that's got to indicate a shift, right? When we see that level, almost a full third of the homes having been overpriced for whatever reason, indicates that we might be seeing a point where expectations, the market is not meeting the expectations of what sellers and real estate people were expecting. Number 3, a community I know nothing about, Anchorage, Alaska, 33.3% of the properties that sold were the subject of price cuts. Number 2, another one that has shown up on tons of different lists in terms of good investment opportunities. Lots of the littler communities of Phoenix, Arizona. Phoenix is gigantic, right, with a lot of little areas in and around it that are all very desirable. 34.3% of the homes that sold did so with a price cut. Well over a third of the homes that sold. And number 1 on the list is Midland, Texas, with 34.9% of homes having a price reduction. Now, Midland, Texas is another one of those communities I know, well, basically nothing about other than what I can see on Google Maps. It's right next to Odessa. It's way out in the middle of nowhere. It's west of Abilene. It's way west of San Antonio. It's very close to New Mexico. It's very near the border with New Mexico. So I don't know what the market is like there. This would indicate to me that we're seeing a market just because of where it is, just because of its remoteness. The implication to me would be that we're seeing a market that's maybe declining a bit. But again, these are all things that you'd want to take into account as someone who is either interested in moving to these areas because we're starting to see a softening in prices, or whether you're in this market already and you may be seeing a situation where we may be in a transition situation, particularly as I mentioned before, if you're someone who rents in these areas, it might be good to get a better handle on exactly what's going on with these numbers, because it may indicate a softening in how strong your position is as a landlord. Now, we're going to go ahead and take a quick break, but when we come back, we're going to talk about some housing predictions from Brad Hunter over at Home Advisor. So don't go away. We'll be right back.
Are you ready to jump in and start your search for your first investment property? Maybe you've decided that it's time to own your own home, or maybe you're ready to sell your home and move on to something new. No matter what your goal is, the Rebel Broker can help. That's right. Aside from hosting this show, I am also the owner, broker of Whitelaw & Sons Real Estate Services right here in Silicon Valley. With over 25 years experience serving Silicon Valley, Morgan Hill, San Martin, and Gilroy, I or one of my great agents can help you achieve your goals in real estate. So if you're ready to look into taking that next step towards achieving your real estate goals, point your browser at www.soldbyrobert.com. That's www.soldbyrobert.com and get in touch. Let me show you how I will earn your business and your respect. Again, that's www.soldbyrobert.com, or you can call me at 408-852-0525. California Bureau of Real Estate ID 00984-909.
Welcome back, everyone. We just spent a little time talking about metro areas that have seen the largest number of homes that have had their prices reduced in the marketplace. Some very interesting communities are part of that. That may give us some insights into whether they've peaked, or would also be a great starting point to figure out what exactly is influencing that number. But it's something, whether you're an investor, a buyer, or a seller, is clearly something you're going to want to take into account to try to figure out what the right next move would be in those communities, because at the very least, it indicates a market that's in a transition, since perceptions on the part of the seller were so out of whack in terms of these areas having set list prices that ended up being unreasonable or unrealistic. All right, so we're now turning our gaze towards HomeAdvisor.com and Brad Hunter with his 2017 housing market forecast. According to him, he considers 2017 sort of a diverging trends year. Their forecast calls for single-family housing to rise at a rate that's going to be on par with 2016, so they're expecting sort of the same. I am guessing that probably as a reasonable range, that's true, but it wouldn't surprise me at all if 2017 ends up being less growth than 2016. If we just want to talk about single-family housing in terms of prices, how much things rise, I honestly don't think we're going to see the same year-to-year percentage increases in 2017 as we did in 2016. Now, but on the other hand, they say multifamily construction, apartments and condos, are expected to fall because of the recent apartment boom and it finally winding down. And I actually agree with that. I think that we're actually not seeing the end. And they imply that by saying winds down. But I know that we still have an awful lot of stuff yet to come online here in the Bay Area. And I think that that's going to have a pretty dramatic effect on that rental market. And then you really need to understand how this affects your local area. But what's interesting about apartments is they affect desirability and renter movement differently. Oftentimes what you'll find is simply as a price concern, renters will move to these places, and it's all a financial decision. And once they get some stability in their income, and once they get a little bit of an increased comfort level, you'll find the very first thing they're going to start thinking about when they're talking about improving their lifestyle at all, the very first thing they're going to do is start looking for something that isn't an apartment. I get this a lot. I talk to a lot of first-time buyers. In fact, my bread and butter used to be these folks. I used to do monthly mailers just to apartment complexes, to these folks to let them know that I'm available to help them buy their first home, or to buy a home at all, whether or not they were in a situation where they had been in a home and then sold it and had to go to living in an apartment, whatever. And that's the mentality that you get. And it's an interesting dynamic because it can oftentimes create a bizarre surge. What I have found is when we've seen big increases in the number of apartment complexes that are available and folks move in and live in them, usually within 2 to 3 years of that, I see a sudden surge in folks who want to get the hell out of there. Sometimes it's even faster than that. But usually that tends to be the cycle that I see. It's people who are just tired of it. They are tired of, and I think this will be even more the case with the cycle we're seeing now, particularly because we've got some units that have been built that are so tall and so compact that it really emphasizes the things that people like least about apartment living. A lot of these folks have very centralized elevator situations. So A lot of the apartments are very far away from elevators, so folks will try to use the stairs, getting stuff up and down in terms of moving, being so close to your neighbors in terms of folks above you and below you, to the left of you, to the right of you. These are all things that get to be very frustrating. And particularly when you see folks who have a child in one of these apartments, the frustrations of dealing with it will really push a lot of folks towards one of two directions. One is to either start renting a single-family residential home or something else that has more elbow room. That could even be a townhome, an attached home, those types of things that are at least an improvement. Maybe not a full-on single-family residential because that rent difference might be too much for them, but it's one of those phenomenons that I've observed, and I think anyone out there who's trying to serve these people by providing a rental unit, or if you just want to understand the likely ebb and flow of what's going to be going on in your marketplace, understanding this as a potential reality in your area is going to be important. And it's going to be important for you to know what new apartments have been built in your area. Now, if none have been built, well, you're obviously not going to be under this situation. But there are literally thousands of more apartment units in southern San Jose, for instance, than there were 2 years ago. So it's a huge influx in apartment living, and not the most desirable kind of apartment living, the least desirable kind. Okay, the single family home increases because of job growth and rising household formations, while the multifamily story has more to do with cyclicality, according to them. Single family starts rising 12.2% in 2017 to just shy of 900,000, while multifamily construction falls by 10.7% to 343,000. So they're trying to project where we're going to see starts. Remember when we were talking about numbers a few weeks back, maybe even a month ago, we were talking about the new home construction not really kicking in or concluding or starting to answer the demands of the marketplace until 2020. And remember, we were making a connection between that, how much time it would take for that to be, and then how much we have primed the pump with subprime borrowers. For those of you who don't recall that one, the point of that was we're doing a lot of the things we did before that created the last downturn. And one of the reasons why there's not a huge amount of concern on my part right now is we don't have as many people who have taken advantage of this subprime lending hysteria as we did before. But if we start to see this growth in single-family residential homes and starting to meet the demand by 2020, well, in 2020, we will have had about the same number of years as we did in 2006 for the preceding 5 to 6 years of priming that pump with borrowers who were doing this subprime borrowing thing. And what that increase in inventory will do will allow more people to buy, but then also set the stage for a potential drop as the inventory has increased. Because there'll be that initial surge of folks who want to buy because there are now homes available, which could really cause a lot of problems for us. Okay, let's see. Factors that shape the outlook that they've put together here is a continued steady but modest job growth in 2017, the risk of slower job growth and income growth in 2018-19, probably not a recession, but just slow growth. I think that's an interesting one to go with. There's an awful lot of folks out there prepping a lot of investor types for a recessionary trend over the next year. We'll see. I don't think there's any question that downturn time is coming. It's really just a question of how severe it is. Next, the development of more long commute locations. I think this is an interesting observation, and I don't think it's wrong. According to them, it'll be driven by worsening lot shortages in the A and B locations, accompanied by skyrocketing land prices in the premium neighborhoods. But I think the long commute locations are going to continue to have more to do with just the price, period. Whether you're talking about lots or whether you're talking about anything else, the reality is folks are going to have to continue to look, because remember, we're not talking about a downturn in prices. We're talking about a slowing in the rate of increase of home prices. So that still equals high prices for most folks. So that's going to push folks who have made that decision, they're sick of that apartment or they're sick of renting, who want to buy. It's going to potentially push them more into the long commute locations, which is, I think, what this refers to. So I think we agree on the development of more long commute locations in terms of buying, but also in terms of interest on the part of buyers. But I think we may not agree entirely on the reasons. Next, rising mortgage rates. According to them, it will force some buyers to lower their sights in terms of what they can afford and may push some people toward remodeling their existing home instead. I think that could be very true for sellers in terms of remodeling instead of selling. I'm not sure if I would make it something sound that statistically significant, but it could play a part. But I think that if mortgage rates do continue to increase to the point where they negatively affect things, and honestly, I don't think they have yet. And if you've looked at the mortgage rates recently, they're actually down. If we go to our good friends over at Mortgage News Daily, we are tending to be hovering closer to the 52-week high, but we're not setting any 52-week highs. In fact, we are down from yesterday. We are 30-year fixed rate mortgages at 4.12, 15-year fixed rate mortgages at 3.32. That's down 0.03. Both of them are down 0.03. FHA 30-year fixed is at 3.75, unchanged. Jumbo 30-year fixed is at 4.18, down 0.02. 5/1 adjustable rate mortgages at 3.0, down 0.02. So all the rates are down. None of them are at their 52-week high. They're in the top half or top third of the 52-week high, but that's it. And the pundits are talking about interest rates continuing to go down. Remember, and I every once in a while get people who poke me with a stick and say, Robert, you're really not on target with your estimation that interest rates are going to continue to stay relatively flat or even go down after the Fed raised interest rates. Well, that's exactly what's happened. Exactly what I told you would happen has happened. We saw an initial reaction when the Fed raised rates. That's the uncertainty principle. Anytime you change things, people wet their pants and do weird things and raise interest rates. This is exactly what happened a year ago when they raised rates by that paltry 0.25%. And then immediately after that, things kind of calmed down. So a week or two later, suddenly rates not only went back down, they went below what they were before the rate was increased. And this is what we're seeing again. Now, has it dropped as dramatically as it did last time? No. Has it dropped as quickly as last time? No. But it's dropped. We saw an initial increase and then it went back down. So remember, when you want to look at these things, you want to look at the 10-year Treasury. That has far more closely been informative relating to what to expect with interest rates. So just keep that in mind. If you're someone who's really in the mode where you're trying to find a home and you're trying to ski along the edge of figuring out when the best time to buy is relating to your interest rates, first of all, I'd say relax. Just find the right house and then work from there. But in terms of just what mortgage rates are doing, I don't see a lot of volatility here. I don't see a lot of things going nuts. And frankly, I'm really sick of the narrative that the reason why buyers are or are not doing something is because of a 0.03% change in interest rates. That is not it. We have been much higher than this before. We have been up at 4.5%. We've been at 4.7%. And I can remember that, and people weren't freaking out. So I know that folks don't want to look at the real reasons why things are still a little wonky in terms of market activity. Interest rates aren't it, though, folks. Just stop buying that narrative. I still see headlines blaming the interest rates for why homes are or are not being bought, and it's idiotic. It's the shiniest thing in the room, I guess, in terms of wanting to blame something that makes you feel better. But the reality is that the reasons why things aren't going great are far more scary, I guess, than interest rates. So, and we talk about a lot of these things here on the show. So if you'd like to review any of those discussions, feel free to browse back on those various items. Okay, and that was a relatively long coverage of the rising mortgage rates thing. So the long and the short of it is, I don't think they're correct. They're talking about rising mortgage rates. I think mortgage rates will remain relatively flat. I don't think they're going to quote unquote go up, because the implication is that is going to be a market influencer, that buyers are or are not going to do things, that sellers will or won't be able to sell their home based on what the interest rate is in 2017. I honestly don't think, barring some amazingly freakish other financial thing that occurs, some crazy money bomb going off or some weird thing, I just don't see the normal day-to-day business of doing what we're doing here in our economy, raising rates to the point where it's going to have any kind of a super measurable effect, or at least not an effect that actually deserves to be laid at the feet of mortgage rates. They may try to lay it at the feet of mortgage rates. They may try to explain it as that, but that won't be the problem. We'd have to be up to 5% or more, I think, before we'd actually see that being a reality. Next, labor shortages in the construction sector, which obviously affects time to build a house and all the other variable costs. I think that could be a problem. I know that when I have several contractors I deal with. I have a contractor in the family. So whenever I have conversations with them, there's absolutely concerns about not enough guys out there doing the work or being available. But the bottom line is also, if there's work, they tend to come. So while a lot of folks want to talk about the labor shortage being a problem, I think it's less a labor shortage problem and more we need the labor to do the work. We need some builders to decide we're going to build some houses here. Then the labor will show up. It may initially slow things down, but once things start happening, you'll see folks step up to take part in doing the work. In their overshoot scenario, they test to see what happens if builders construct more aggressively than expected. They see that total housing stats rise to nearly 1.4 million in 2017. Multifamily moves higher for another year, and then there's an aggressive contraction, partly due to some overbuilding, but also because this scenario explores the possibility of a general economic recession in 2018. That's kind of an interesting one. It kind of goes a little bit against some of their previous assumptions. Is there a high probability that there's going to be at least single-family housing starts rising in 2017? I don't think enough to really make a big impact. They have a slow climb scenario where we see builders moving ahead at a much slower conservative pace, and they end up getting to 1.3 million again by 2019, but they get there more slowly. I think this is the scenario our other sources have talked about, where we don't start to see a big dent in the inventory numbers until approaching 2020. And again, by then we've had some time to prime that pump with enough subprime borrowers that they represent enough of the pool of current owners of homes that if things go nuts and they start abandoning their mortgages and just not paying and doing what happened last time, we're in deep doo-doo. So some interesting things to consider here. We've got some interesting fodder for you to roll around in your brain and see if anything pops up that is something that might affect your investment strategies, particularly with some of the communities we talked about in the housing markets where homes had the largest number of properties that had price reductions. I hope that this has been some valuable information for you. I really appreciate you spending your valuable time with me. Thanks for listening, and I'll talk to you all next time.